This is our Forex blog for August 8th, 2011. And like most days, we want to start with a currency meter to find which currencies are the strongest and buy those versus the weakest. Clearly the yen was relatively or extremely strong most of the day with very little mild weakness for half an hour to an hour at times. The euro was pretty weak from 8 to about 10. The CAD consistently weak all day, and the Australian and New Zealand had their extreme strength and weakness that lasted for a few hours. But the CAD, pretty much a no-brainer. Sell it versus the strongest yen. And one of the things that we've recently put in the software is the ability to have range-based bars. They can be 5 pips per bar, 6 pips per bar, 7, any number you want. Let's look at the CAD yen. If you normally trade, for example, a 5-minute bar, and first of all, let's just notice that the trend clearly went down from about 4:30 throughout. It just trended down. So if you want to do a range-based bar, which gets rid of a lot of the noise, you can put on a function called ATR, and you might want to look at the median as well. And this shows you how many pips per bar this currency normally moves on a 5-minute bar. If you want to trade something equivalent to 15-minute bars, you can put this on there. You can see the average is around 6, the median is also around 6. But during certain times of the day, it's higher. You could scroll back and see that this particular bar of the day has 8 and 7. So you might agree to use and round up to maybe use 7 pips per bar for this chart, just to kind of approximate what a 15-minute bar would look like. So bring up the CAD yen, put, let's say, 7 pips per bar. R stands for range-based bars. If you want a 50-tick chart, you just put 50 there with nothing after it. To use the range bars, just put an R after it. Alright, so here is the 7 pip per bar range chart. And compared to the regular bar, you can see it really does a good job of taking out a lot of the noise, and it also lets you see levels extremely well. The market's trending down. Trend lines work really well on these. Fibonacci areas, of course, work. You had a trend line break there. It kind of rallied back up, ran out of steam. You might have went short there or when it broke the low. And it barely broke the previous low here, so you get out of that trade with a nice small 20 pip profit. You see a nice little consolidation right here. It might break down. If it does, you go short with your stop right above the high. You're risking a reasonable amount of pips. You use the number of pips per bar plus 1 to 3 pip padding above the high or low. So if you sold right here, if it had gone down, you put your stop 1 to 3 pips above the high, and therefore you're risking a reasonable amount on this currency because it's based on the last 20 days average volatility for that time of the day. If you went short right here, notice it came down a little bit and didn't continue. You're out, barely made a higher high here, and at that point, the market just kept trending down. The CAD yen, eventually did continue its trend, and you can see here coming up to 330, the CAD, lost its strength, and really around 430 became super weak. That's right about right here. If you notice that on your chart, you had plenty of time at 430 to sell this low, and it just absolutely took off. And you can draw your fibs off this previous swing to get an idea of where your profit target would be. So you're short somewhere around 20, out around 75, maybe 45 pips in this case. You're risking 7 pips plus a max of 3 pip padding, 10 pips, to make 45. And if you took a bunch of the other trades like right here, more than likely you made 20 on that. We're all risking 10. You shorted right here, you probably broke even or maybe made 3 or 4 pips. If you shorted right here, you might have got out of here and you had to sell the low again here. You might have got into that trade a little bit early. But the point is, the range-based bars really improve the accuracy of the chart, and it's a lot cleaner. Notice, the 15-minute chart. Where would you have really got into this trade? I mean, there might have been some fewer trades. Maybe you would have got in here when it broke, kind of went sideways. There wasn't really the same clarity that you had on a 7 pip per bar chart, and that's why I'm a big fan of this. Notice all the other trades you could have taken and maybe made a few pips, especially the first one. Easily could have made 20 pips, the second one 5 to 10, third one you might have even got in before, the ultimate trend line break that, caused the collapse. And notice there's not much movement here, and you have a nice little sideways rectangle pattern in a tight 25 pip range. It just finally broke down and went lower. Let's look at some of the other currencies that you would have taken. The yen was clearly the strongest. You might have started trading the euro yen from 430 onward. Say you want to normally trade a 15-minute chart. Now the average is between 8.3 to 8.6, but if you trade normally from 3 to 11, you can see some of the peaks in here go up to 11, 13 pip median. Here you have 12 and 12. And so the averages for the whole day, there's a lot of times where the market's obviously lower than average and some above average. You might decide to pick, 10 or 12 pips for the euro yen to approximate a 15-minute chart. And so when it's dead and it's not moving, let's say 12 pips per bar. Now I'll change this to the euro yen. And it's going to give you a lot more opportunities to find sells. Now keep in mind the euro went really weak right around 4. Notice how few bars there really is until the market really starts to move, and you have a lot of bars in a very short amount of time. Let's hold on a second here. Let's click on the chart and it shows you the time. There's 4:36, and here's coming up to 4 right here. And you can clearly see a nice counter trend move where it broke the trend line, and a lot of times when trend lines get broken, the market comes up and retests them. You either sold it there or you sold it when it broke the low, but you just had you had a half an hour head start as the euro started getting weak and the yen was strong all day to get short this, and it just absolutely took off. And once you're in a trade, you can use many of our existing tools. The parabolic stop and reverse does a pretty good job of getting you out of trends. Notice it went short here and out, short again here and out. Or you can use the chandelier stop and also our FX and telestop, which soon will work on range bars, but it does a really good job of working on a 5-minute, 5 minute chart. Now, let's say you trade the U.S. session. The Swiss has a very strong longer term trend. Daily, weekly, monthly trends up. At 10 o'clock here it becomes really strong. At 10 the euro is still mildly weak. The CAD is probably the most consistently weak all day. So why not trade the weak CAD against the strong Swiss? Let's first see how many pips normally moves in a 15-minute bar. And so one of them's 8, one of them's 9. During the active times it can maybe get up to 9 here, 12 on that bar. So you might use an 8 or 9 pip per bar chart. Let's first go to a 15-minute chart on here, and I'll put the CAD Swiss up here. And notice, there's a few good trades as the Swiss really became strong, but it really barely went anywhere for a very long time here. And notice, how much wasted space this puts in. You can only see back on this chart till about 11 o'clock yesterday. So if you use, let's just say 10 pips per bar in the CAD Swiss, notice, if you wanted to sell this on a move up, it kind of ran out of steam, and just nice smooth moves. And you also have that trend line break right here as well. It looks a little bit cleaner on a range-based bar. Let me get rid of this here, redo it. And this low to here. You're risking just a few measly pips above the high, and it just absolutely takes off. If you want to, when you see the Swiss get strong and the CAD was weak all day, you can just simply draw your trend lines to get out of the trade as well. You're short. You made about 55 pips on that trade. went sideways here, you get back in it. Unfortunately, it double bottoms right here and doesn't go lower, so you have a very small profit. You go short again right here. You might have also got out of here with another 20 pip profit, and then when it broke and finally went lower, you go short, and you know exactly where your profit target is. You never know if the market's going to stop at the first fib target or go to the second, and sometimes below the third. Normally, you're taking this trade, you're going to risk maybe 10 pips to make 50. Yeah, but in this instance, it's so weak that it closes at the low, and you want to yank your stop right above that bar's high as a decent place to get out, but it keeps going lower. So then you move your stop above here, because usually it stalls at either the first or second. You know, usually it hits the first one, goes sideways, and then oftentimes goes lower. This one just was so weak it just went through it, and you get out at the first green bar, or when it goes a pip above that green bar out right here. So you really clean up on this trade. 75, 79, you're short at 50. You made about 80 pips on this trade while risking maybe 10 or 12. You know, add 1 to 3 pip padding. No more than 13 pips was your risk, and you might have even got into this double top here and just kind of expecting anytime a currency double bottoms, usually it reverses. This one really didn't take out that high, so you might have initially went short there on this first pullback. It's kind of going sideways. You yank your stop down. You know, went sideways again here. You yank your stop down. You don't know if it's going to go down here, and at that point, you're really home free, and you made your huge profit with a very, very tiny amount of risk. So range bars are really, I think, the future of trading, and you know, allows you to pick a number of pips that make sense for your style of trading. If you like to trade on 5-minute bars, then that's fine. You can see the average is slightly less than 4 here, and the peaks, you might want to find some bars that give you an idea of, you know, during the 2 to 4, there's some really wild swings in here, and the average is way underneath that. So you might decide to use, you know, maybe 6 pips per bar for, you know, making something that's equivalent to a 5-minute bar. And so here you can see, you know, it broke down and went sideways right here. You might have went short. You're risking less because you have a 6 pip bar instead of a 10 pip bar. And the same thing, you know, if it doesn't break the low here, you're out. But, you know, this is a nice 25 pip move, so you easily made 20 pips on there. Kind of came up. You might wait for it to break the low here. And again, it's going down. You move your stop here and here. And you might have gone stopped out here and having to get right back in it, which if you have a super tight stop is bound to happen. And then you're out of that trade down here near 75. In this one, you know, 6 pips per bar, just straight down. It really gives you a very beautiful feel, and you can approximate regular minute-based charts. Another tool that works really well on range bars is using a displaced moving average, which is very fast, but it's not so noisy. So maybe use a 3-bar shifted 3-bar shifted 3 to the right. When price is underneath there, you go short. You know, you can kind of use this. If you're shorting the weakest one, you know, you got some small profits, but you also have some very nice big 50 pip profits. When these things take off, it stays, you know, outside of those, you know, very fast moving averages. And obviously, when the market's chopping around here, you kind of wait for that break. You know, small profit, small 10 pip profit, 20 pip profit, 20 pip profit. But you can use this kind of as an entry-exit tool as well. There's a lot of things you can do on range-based bars that do not work very well on minute-based charts.